0.71%. And now, family members, let's go ahead and let's take a look, okay, at macro positions. Now, we're talking about ETFs that now are more in line with broader indexes that will get us P.A.I.D. Now, I need for you to take copious notes again, because all of these are slam dunk positions now that are waiting to get your P.A.I.D. And it's up to you to take the initiative to study these particular positions and determine whether or not they are plausible for the goals and objectives of your portfolio, and then govern yourself accordingly to get paid from these positions, okay? So now let's go ahead and let's do this, that. Let's go ahead and look at some additional macro positions. Now, whenever you hear me say macro, we're talking about ETFs. And as a result of that, an ETF means, that's an acronym for an exchange traded fund that actually holds multiple positions inside of it, okay? So as a result of that, there's always a weighted index that you have to pay attention to, because based upon how that position is weighted, that will determine how that position will move based upon the most heavily weighted positions in that particular macro or ETF. So it's very important that you always keep that in mind when you are dealing with an ETF. You're not dealing with one particular position, but you're dealing with a position that has multiple positions contained therein. That's very, very important. All right. Now, having said that, let us now go ahead and look at some macro positions that will get us P.A.I.D. throughout 2017. All right. Now, hold on to the safety bar, because the market is off to a wild start this year in 2018. Not only that, more than $1 trillion left actively managed exchange traded funds last year, and most of it found its way into passively managed ETFs. Thus, ETFs continue to be very, very popular, even though many of them are essentially duplicates of one another. Now, returns should never be assessed in a vacuum. It's easy to put together a list of ETFs and see which were the best performance in a given period of time. But all you'll find is that leverage ETFs will be at the top of the list. This is how most investors think of it. And that is fine for some if you don't care about risk, okay? What I have done and what we're about to do now is we're going to be looking at 5 ETFs that are poised to beat the market in 2018 without a lot of risk. Okay, so at this particular time, let's go over a list of 5 non-risk adjusted, non-leveraged ETFs that will get you P.A.I.D. during 2018. First position, you already know it. P.A.I.D, S&P GSCI Crude Oil Index, position symbol OIL. OIL will get you P.A.I.D. per the movement of oil. And what I like so much about OIL is that it allows me to act like a Rothschild on the position. If oil is rising, OIL will rise. If oil is pulling back, OIL will pull back. It's so very simple to make money off this particular position. So Wealth Institute families, OIL should be a position that continues to carry heavy consideration for inclusion into your portfolio in 2018. Now, OIL is an ETN that reflects the returns available through an unleveraged investment in West Texas Intermediate crude oil futures contracts, plus the Treasury bill rate of interest that could be earned on funds committed to the trading of the underlying contracts. Okay? Now, OPEC seems to be playing nice with its members right now. So, that should send crude oil prices significantly higher through the year. OIL is already up 3.21% this year, family members, and it's been paying us handsomely. All right? And many analysts think that there's as much as 40% more upside with OIL in 2018. So therefore, we need to keep our eye and keep getting P.A.I.D. from OIL in 2018. Next position I want to give you is the DWA, Emerging Markets Momentum Portfolio, symbol PIE. Now, PIE was up 42% in 2017, but this came after 4 years of pretty weak returns. Now, the emerging market sector is lagging when compared to the domestic market explosion. Money is flowing into emerging markets as well, as institutions and investors are looking for sectors that not only lag, but are also not as heavily correlated to the United States markets as many investments are. Now, while the correlation is not as disconnected as it used to be, emerging markets are increasingly becoming correlated, and non-correlated investments like this particular position, P.I.E., okay, should be one of the ETFs to beat the market in 2018. So, Power Shares, DWA, Emerging Markets Momentum Portfolio, symbol P.I.E., a clever way to put us into the emerging markets and get us P.A.I.D. The next position I want to give you as we look at a broad base of ETFs to get us P.A.I.D. through 2018 is the iShares Global Materials ETF, symbol MXI. Now, MXI is likely to outperform the S&P 500 in 2018 as manufacturing picks up around the world. Now, the manufacturing index here in the U.S. is indeed climbing as it is in Europe. Housing starts, building permits, and construction spending is increasing here as well. Now, of course, manufacturing means materials are needed, and that means lots of buying of material. Now, if we add the possibility of a Trump infrastructure spending bill, so much the better then, leading MXI to be one of the ETFs to beat the market in 2018. iShares, Global Materials ETF, symbol MXI. The next position I want to give you is Power Shares Buyback Achievers Portfolio ETF, symbol PKW. That's the Power Shares Buyback Achievers Portfolio ETF, symbol PKW. Now, PKW should also outperform the S&P 500 this year in 2018, and that's because of the ongoing trend of buying back stocks at unreasonably high prices using debt and the corporate tax cut, which I've been talking about throughout today's Classroom Not Malls radio broadcast. Now, while many companies will pass on the tax cut savings to shareholders in the form of dividends or reinvest the money, others will pile on the buybacks, and they will buy back more of their shares of stock. That will push those stocks higher over the course of the year. And PKW is an excellent cadre of positions that are poised to do just that. The next position I want to give you is the Consumer Discretionary Select Spider ETF, symbol XLY. Now, XLY will do well this year because consumer confidence is not only at multi-month highs, but because household debt continues to increase. Listen to me. Now, the American consumer keeps drawing down debt and using it to buy stuff that they don't necessarily need that aren't staples. Thus, discretionary purchases are where we will continue to see money flow into, and that should push up the stocks to fill out this particular sector and get you, me, we, the ASK THE WIZ Wealth Institute family, P.A.I.D. Consumer Discretionary Select Sector Spider, ETF symbol XLY. And it's also an excellent position to utilize our ASK THE WIZ Wealth Institute holding strategy on to get you P.A.I.D. You've just received a list of 5 broad-based ETFs that will get you P.A.I.D. throughout 2018.